Other people believe that foreign exchange trading can be a way of timing the business cycle of countries. Right now, we saw recent reports for the United States that our gross domestic product was up, while the number of new jobs created was down or non-existent. This is an example of trying to time a business cycle. Everyone's hoping for the United States gross domestic product and job market to catch up to give us a clear vision of whether the stock market's going to go up or whether the dollar is getting stronger or weaker. Or we're looking at whether or not the Federal Reserve is going to increase interest rates. So we're just trying to time business cycles, and this is a view that you can take. Some people believe foreign exchange trading can be seen as a way of finding countries where economic growth, inflation, and real interest rates are at extreme highs or lows in relation to similar countries. And this is definitely a definition that can be used, or an idea that can be used when we're talking about Hungary or Romania or many of the other countries that are planning to join the European Union. You're looking at countries that are offering high interest rates in the Eastern European countries, attempting to join the European Union, and there has to be some kind of parity in order for them to join. So there's many opportunities there. But no matter how you look at the foreign exchange, the values of these currencies are constantly in flux around the world. And the goal of the people who use foreign currencies as hedgers is to actually go back to what was occurring with the Bretton Woods Agreement. Many countries do not like the fact that their currencies fluctuate 20 to 25%. And people who are importers and exporters don't want that to occur to them as well. And so everyone's actually striving to reach that 1% fluctuation so they can maintain their profits. And so you, as a speculator, have the opportunity to grab that difference, since all they're looking for is the basis. Now, there are two arenas to foreign exchange or Forex trading. Currently, the most popular and most advertised form of Forex is the cash market. But there is a futures market that is actually developed and was developed prior to the cash market, if not simultaneously. And so there are actually two arenas in order to trade foreign exchange. There's the cash, also known as the spot market, as well as the futures market. Now, most of the cash and spot transactions happen over the counter. And as we saw with the long-term capital management fiasco, most of their transactions were happening over the counter in the derivatives market. So there's a lot of leverage in the over-the-counter market. And this is done particularly between banks, and now a lot more dealers are now participating, so between dealers as well. So where it was once before called the interbank market is now more appropriate to call it the interdealer market. And the futures are done on exchange-traded markets. And we talked about that, as I said before, in length in the trading futures and traditional commodities, the various futures market. But now we're going to narrow it down in this seminar to the three main locations that foreign currencies are traded. First, we're going to start off with discussing how the cash market works and what it looks like and the different factors involved with it. Now, in the OTC, interbank, and interdealer market, we see that there are three core ideas that us as speculators need to be able to understand as we drive forward to investing in it. Number one, who are the players? Who are you against when trading foreign exchange? As everyone knows, foreign exchange, futures, options tend to be a zero-sum game. And there are typically one group that are speculating and one group that are actually using the items that are being speculated on. So it's good to know who the players are and who you're up against when it comes down to your turn to speculate. We also would like to know what they trade as well as how they trade these markets. Do they have a particular way that they hold on to contracts? How long do they hold on to contracts? And why is the market trading that way? Then lastly, we'll talk about the advantages and disadvantages to trading these markets for speculators. While we know that many major banks have unlimited resources to trade these markets, us as speculators need to know what our limitations are and what our benefits are in trading such a volatile market. Banks and dealers. Originally, Forex was simply traded between banks. Banks dominated the marketplace because they were able to extend the amount of credit. They created the leverage for each other to trade such volatile markets. In a report designed by the Federal Reserve Bank of New York, there were 93 major players in the United States. Of those 93 major players, there are 82 commercial banks, which are Deutsche Bank, Bank of America, Wachovia, you name it. Any major bank that's out there participates in foreign exchange trading, as well as many banks that are overseas that have branch offices. So that's what falls under that banner of 82 commercial banks. Then there were about 11 investment banks or insurance firms. There are many insurance firms that trade annuities that have to participate in currency exchange, and a lot of those can be found in Swiss countries, as well as many major investment banks such as Goldman Sachs that trade foreign currencies. So a lot of players in this marketplace. And the total volume of transactions between these traders actually equals to about 50% of all of the currency trading in the world. So us as speculators really take a back seat to the amount of transactions done in the interbank and interdealer market. Now, over time, a lot more players have come to the market, which are not investment firms, insurance carriers, or banks, and those are known as dealers. And those tend to be large firms that focus on improving currency exchange rates for importers and exporters, and also give a window to average speculators or small speculators like you and myself. Most of these major banks are based out of New York and can be found working hand in hand in some respects with the Federal Reserve Bank, getting a lot of information from them, learning what the Federal Reserve Bank requires of them in their lending process and procedures. And then there's a last group of banks that participate in foreign currency exchange, which have a very heavy hand, and we mentioned that already. The Central Bank of England, we mentioned the Central Bank of Hungary. We even talked about the failed attempts of the Central Bank of Asia, of Thailand and Malaysia, attempting to get involved. And so the central banks of many countries have a very heavy hand in trading foreign currencies to protect their economies. Now, what they trade, they have a lot of tools at their disposal, which gives them a lot more opportunities than the average speculator. What the average speculator or small speculator trades is the spot market. And the spot market is very simple. Say, for instance, you decide to buy European currencies on Monday. If you decide to buy European currency on Monday, you are required to take delivery or to give delivery of that European currency come Wednesday morning. If you don't give delivery, then you're forced to roll over your position until the next 2-day period of delivery. So these are real cash positions that you're involved with as a speculator, and this is 90%, if not 99%, of the type of speculation you'll be doing. Whereas the interbanks, and the interdealers trade multiple types of currencies, and this affects how your spot transactions operate and how successful they are. They trade the pre-spot market, which is actually settled 1 day after the deal date. So if they bought European Union currency on Monday, they'd have to settle it on Tuesday. And then there's the pre-spot, which is the cash market, which is settled the same day that it's bought or sold. They also trade what are known as Forex swaps. As you become more sophisticated in trading Forex OTC market transactions, you're able to trade Forex swaps, in which where you have one spot transaction protected with a forward transaction. Again, a customized contract that you're not going to do up front, but it's something that many Forex traders have to do if they intend to hold very long positions, longer than the 2-day trading.